Okay, we're looking at Chapter 11, Application Problem 12, and we're going to go into some of the differences between GAAP book income and taxable income. So on Problem 12 there on page 329, we have EFG, a calendar year accrual basis corporation, reported $479,900 of net income after tax on its 2010 statements prepared in accordance with GAAP. The corporation financial records reveal the following information and gives us our list, and then we are to compute EFG's taxable income and regular tax. So we're going to make those adjustments here. So we start off with our $479,900 net income under GAAP. Next we go to EFG earned $314,800 from a qualified domestic production activity. On page 314 of our book, it talks about the reduced tax burden on domestic manufacturers. So we have a domestic production activities deduction equal to the following percentage of the lesser corporation's income from qualified activity over its taxable income before the deduction. And the amount of deduction for any taxable year can exceed 50% of total compensation that the corporation pays to its U.S. workforce. For 2010 later, that percent is 9%. So in this case, we have $314,800 from qualified production times our 0.09% deduction. So that is going to, oops, I need to put a minus here. So that's going to give us a deduction of $28,332 from taxable income before that deduction exemption in the tax code for domestic activities. Next we have EFG earned $10,700 on investment in tax-exempt municipal bonds. Tax-exempt municipal bonds are not subject to tax, so therefore we will subtract $10,700 from our book income. Okay, net bad debt expense. So bad debt expenses, it's done on an accrual basis for accounting purposes. So we had, in addition to the allowance of $3,700 for the year. So that's what we would have deducted on our books. Under tax purposes, we go by our actual bad debt write-off. So our deduction there is $4,400. Our difference then is going to be $700 reduction in net income. So we're able to take $4,400 more on taxes for deduction than we were under our accrual basis of accounting for the book purposes. Next we have a EFG paid a $6,000 fine for a violation to a local zoning ordinance, and those government fines are not deductible for tax purposes, so we're going to actually have to add that fine back in because that is a deductible expense under GAAP, but under tax purposes government fines are not tax deductible. Okay, next one down there we have EFG's depreciation expense for the books was $44,200, and as we know, makers differs from financial accounting depreciation. So our maker's deduction for depreciation was $31,000. So we actually deducted more income from on our books than what we did in tax. So that's going to actually add income to it. So we're going to have more taxable income, less of a tax deduction, more income for taxable purposes than we are for book purposes. Okay, next we're going to go to our section 1231 gains and losses. This is EFG's second taxable year. In its first taxable year, recognized an $8,800 net capital loss. So remember, we can't deduct taxable losses up to taxable gains. So in this year, it recognized a $31,000 section 1231 gain on the sale of equipment. Remember, 1231 gain is postponed until the sale, but we can then deduct though that loss carry forward. So we can take that $8,800, reducing our 1231 gain basis there. So we're going to, that 31,000 is now, gain has been reduced to a net of whatever that is, 22 or something like that. So anyway, we're able to now, because we have that section 1231 gain, we're able to actually use that $8,800 loss. Okay, so we have that, so that's going to reduce our taxable income. Amortization of organizational cost. So we have, in this case, in the first year, EFG capitalized $6,900 organizational cost for tax purposes and elected to amortize it over 180 months. For book purposes, it expensed the cost, so it would have been expensed last year. So we are going to have a reduction of income by that. So our amount is going to be equal to 6,900 divided by 180 months, okay, times 12 months, or $460, and that's a deduction, so I need to change that to a minus. Okay, so we're going to reduce our taxable income by $460. Okay, finally, EFG's federal income tax expense for the books was $241,589, and because that is that's how we got our net income, we're going to add that back in to get a before tax income. So our taxable income then is going to be equal to $691,697. Okay, so that is our taxable income for a year. Our corporate tax rate is 0.34. So our regular tax is equal to our $691,697 times the 34 rate, or $235,177. Okay, so if we were to go ahead and do the Schedule M1, we put the net income per books, we put the federal income tax per books, and then we do basically a summary reconciliation of what we just did to get down to our $691,697 of income. To get that, we add back the difference in depreciation. We add back in the fines, because again, that's non-deductible fines. Income recorded on the books not included, so our tax exempt interest of $10,007 would be on that schedule. And then we have other deductions, which would be our amortization of the organizational cost, our production activity deduction, bad debt deduction difference of $700. And so that form M1, Schedule M1, is just a brief summary of what we've charted out here to show the difference of how we went from our book income to our taxable income. And that is how we do those conversions. Again, those can be, as we have different things in the tax code that are deductible, or timing differences such as depreciation and bad debt expense. You will see those adjustments to net income, and there's also, of course, like municipal bond interest, that kind of stuff that never gets taxed, or that's not just a timing difference, that's a permanent difference. So we always want to show and reflect that. So again, this is how we do adjust our net book income to regular taxable income.